In this video, we'll be looking at capital structure. And so I will tell you what capital structure is, and then also give a few examples and why companies choose to pick one capital structure over the other. And so I'll first explain capital structures. And so let's say you start a new company and you have exhausted your personal funds, but the company needs more money to continue operating. You would need to go out and find a way to finance the company, and this is commonly done through either debt or through equity. And so first looking at debt looks like a lot of different things, but they are essentially loans. So think small business loans, bonds, and traditional business loans. And then next we'll be looking at equity, and this is when money is exchanged for a portion of the company, most commonly known as stocks. So now let's look exactly at why a company would choose debt. The first reason is that debt is in most cases cheaper than equity, and the next slide will go over exactly why this is the case. And then the second main reason is that some company owners do not want to give up a portion of their business. If they choose to take out a loan, they do not lose a portion of their business, but instead they have interest payment requirements that we'll go over later in the presentation. Now that we've gone over why a company would choose debt, let's look at exactly why debt is cheaper than equity. So as you can see from this example, the company has interest payments. So I'll direct your attention to the $200 interest payment that the company pays close to the bottom of the income statement. And as you can see, the interest is taken out before the taxable income. And that taxable income is then times by the tax rate, which in our case is 26%. And so what this means is that the interest payment provides the company some sort of tax shield. And so how the interest payments that are linked to loans is one of the main reasons debt is cheaper. Now that we've looked at the reasoning behind debt, let's look at the reasoning behind why a company would choose equity. In some cases, a company will have too much debt and they are afraid that current conditions will not allow them to pay off future increases in interest payments. So let's say that instead of $200 interest expense from the company that we looked at in the previous slide, the company instead had an interest expense of $2,000. Any increase to that could cause strain on the company. In equity financing, there is less stress on the company in the sense that equity investors do not require a monthly interest payment. They will, however, may be looking for a dividend payment, but if the company cannot pay the dividend, that will not automatically make the company go under. And then the second reason has similar logic, but the company is instead seeking debt financing and the banks decides that they're too risky to lend to, and the next best option is to find an investor that is willing to give them money in exchange for the company. So now let's go over some examples. One way to see if a company has the ability to pay off a loan is looking at liquidity ratios. For this example, I have chosen the debt to asset ratio. From the balance sheet, the company, as you can see, has $2,300 in debt and $43,400 in total assets, resulting in a debt to asset ratio of 0.053. What this is essentially telling us is that for every $1 of assets, there's about 5 cents of debt. And so this is an encouraging ratio if you're trying to take on more debt rather than equity because they can easily cover their current debt. And now that we've looked at the balance sheet, you can also look at the income statement. And so for this example, I've chosen to use the interest coverage ratio to see if the company can cover the current interest payments. In this example, you can see the $200 interest payment and the operating income of $10,700. This results in an interest coverage ratio of 0.019, which essentially says that for every $1 of operating income, there's only about 2 cents that's going towards paying interest. And again, if you're looking at debt, this is encouraging because a lower ratio typically shows that you can cover your interest payments. So if you were Computer Services Inc., what would you do? If I were them, I would choose to take on debt rather than equity. My main reasoning behind this is that debt is cheaper, and then along with this, from the ratios we calculated from their income and balance sheet, they have the ability to pay off their current debt and have room to take on more debt considering a debt-to-asset ratio of 0.053 and an interest coverage ratio of 0.019. If Computer Services did, however, choose equity, it would cost them more, but it could allow them to operate in a less stressful business environment because they do not have to worry about new interest payments.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.